What's going on, everybody? Welcome to a Capital Hungry Market Update and Trade Ideas webinar. It's currently Tuesday, November 8th, roughly 6:40 p.m. Eastern. Well finished the North American trading session and going to be doing some analysis, understanding what's going on in the markets, and setting up some trade ideas that people can use to scalp based on or day trade, of course, continuing from the last market update webinar. Because basically the last market update webinar, sorry, if you watch that educational review in the last market update webinar, we did have primarily the pullback we expected on dollar, equity squeezing to better sell points, and of course, gold breaking above the 1680s and those adapted buys. The only thing that was out of the ordinary was on gold individually as its own beast precious metal, and its own unique trading instrument here, different than obviously how the US equities behave, or of course currency pairs like GBPUSD, is that we had this extra extended upside move. Now we were looking for the buys above 1680s. If we fail to continue to trade below 1670s, and we're able to identify dollar softness as well as a relief rally in equities, bringing that information together to the table in terms of market sentiment and adapting to market waves. So I got to edit this alert too. I don't know why it keeps triggering at 167.5. But anyways, our expectations from the market update webinar was I was personally expecting that if we do break above the 1680s, we would get some type of reaction at around 1700 flat. Instead, because markets overall have been illiquid and have seen higher volatility, this can lead to way more aggressive movement when that volume does come into play. And of course, we have those algos take over. So what I mean by this is, we expected, for example, dollar still to pull back to range lows and possibly retest 110's 109.5 handle. We expected on the intraday timeframes, US 30 could still come to retest 33,500 and do a bit deeper of a liquidity grab and still end up rejecting and overall continuing more bearish on the higher timeframes, depending on the US CPI data to come. We expected EURUSD pullbacks to at least revisit this previous sell side liquidity zone, UCAD to at least revisit key level 1.34, and GU to even double top at around 1.65 before seeing some more exhaustion signs. It was only gold that moved a bit abnormally compared to what we expected, where we were expecting that if we break above 1680s, also have the market sentiment confirms of dollar bearish during the session, equities and other risk assets seeing that relief, besides obviously crypto, which had its own individual fundamental impacting factors with FTX pretty much going under. But in terms of gold, I was expecting at least for us to get a squeeze up to like the 1700s. We're still following our macro information advantage and pull back above 1680, except we dug a lot deeper into this sell side liquidity zone around the 1720s. So we will be adapting to this accordingly, where we could still see some potential squeezes into this sell side liquidity zone, retesting these better price points of interest before jumping back into the higher time frame trend. And the example of EURUSD can still retest 1.01, even going up to the key level before jumping back into higher time frame trend. UCAD would still need more exhaustion confirms, holding of 1.34, and US 30 would need more exhaustion confirms, rejecting 33,500, on top of dollar domination coming back into the scene from a fundamental perspective. The main fundamental catalyst this week that would bring dollar strength back into the scene, stock market bears and gold bears, is if the US CPI report is high, still showing that there's been no improvements or decrease in inflation. So the Fed's hawkish path is going to continue and there's going to be no December slowdown. Plus the other US economic data, such as consumer sentiment reporting, is still relatively healthy. This shows that the economy from the consumer side of things is still robust enough to handle continued rate hikes. If the CPI data is showing improvements and the consumer sentiment data is bad, showing that recession scares are developing, those would lead into feeding Fed pivot prayers, and of course lead to further dollar weakness, further upside on the stock market, and even further upside on gold, potentially breaking above the 1725s, low 1730s here. Does that make sense to everybody so far? So the main reason for these upside and pullbacks, which we played accordingly from 1640s to 1680s, and then we're starting to look for any sell side confirms, which we did not get to hold extended. And then the main reason for the 1680 extended buys, where we were looking for sells at 1700s, was new monthly order flow still setting up, failure to break previous significant lows, and not enough sell side liquidity to break lower, with the FOMC sentiment being priced in that period of time. Then we also had the failure to break these lows, new business month setup of order flow still, bad unemployment rate data that also led to dollar weakness, dollar and other dollar having a deeper pullback, revisiting range lows, leading to risk assets having a deeper pullback, such as equity markets. And then we also had that break above 1680s. Now, it's not like gold hasn't done aggressive pullbacks before and faded it out, right? Even this sequence of events from these lows is very, very similar here. We can still see potential buys up into these sell zones of interest before we start to notice more exhaustion signs. But from a higher time frame perspective, it's very hard to see continued higher time frame buys unless we have dollar breaking below the range of 109 flat, which we've been talking about on the higher time frame and intraday perspective. And we'd also need improved inflation data, bad other US economic data, and breaks from a technical perspective well above the 1730s to see a real shift in structure on the higher time frame and a break above this key price point of interest. Because just because you may be breaking a trend line doesn't mean you're breaking market structure. When you're looking at market structure, the key price point of interest that led us into these lows was the general accumulation of order flow here, and then the pullback phase and accumulation of order flow here. Here, as we revisited these previous lows, we failed to break, had a bit of a consolidation and accumulation of order flow and rejections at 1720s, a high 1720s, low 1730s, where from this price point of interest led us into these lower lows being printed here, right? So even though we may be breaking a subjective trend line or a various piece of market structure on the intraday timeframes, like somebody could say, oh, well, we're breaking above this key area, for example, market structure on the higher time frame and on any time frame is based on price points of interest that have led to significant movements of order flow. So you can easily assess that as sellers came and revisited this previous low, we didn't instantly have enough order flow to break, and we accumulated that order flow to have enough sell side liquidity to revisit and print lower lows from the high 1720s, low 1730s. We had a pullback phase to the same sell side liquidity zone and area that led to these lows again. Now, for us to break above this very key liquidity zone, as we're getting rejections here again, showing potential chances of more higher time frame upside on gold, we would need fundamental catalysts that feed into pivot prayers, or of course, any new global fear, uncertainty, or doubt, like China actually starting to invade Taiwan or something of that nature. So to me, we can still play some potential buys into here as we're going into CPI data and of course into this major liquidity zone on the higher time frame. But to see any further upside, we will need a catalyst of improved inflation reading or of course very bad US economic data, which both of those catalysts feed into Fed pivot prayers, would bring more impulsive weakness to the dollar and would lead to a relief rally and continued upside on stocks and a break above the 1730s here on gold. Does that make sense to everybody? Right? So we played the FOMC sells and the sells from 1680s, 1660s down very well. We were looking for continued sells from a recap standpoint if we could have FOMC hold enough weight and break these lows, except then we had a deeper pullback phase that following daily period, and to close off that week, unemployment rate data was bad. So we adapted to the continued buys to the upside to at least revisit better sell zones of interest, looking into this first liquidity zone of interest being around the 1680s. Right? As we approach the 1680s here, into this new weekly period, we had the weekly candle and daily candle push down and gap down first, not have any type of upper wick. This was still giving us confirms of exhaustion at 1680s, but the weekly candle not having an upper wick, plus the market sentiment confirms that dollar was still relatively weak and equity seeing strength and not being able to break that double top neckline and trade back below 1670s showed us that our market update, if we can break above 1680s, we would adapt to continued buys. We expected those buys to at least come and revisit the next potential zone of interest, which is roughly these previous significant lows around low 1700s. Instead, because markets are very illiquid, and when you have high volatility and that volume come into play, we had gold extend even higher in impulsive fashion, digging into that major higher time frame sell side liquidity zone around the 1720s here. Right? So we expected this entire downside with the prior market conditions in FOMC. We expected that we would dig lower, but did not have the fundamental confirms for that as unemployment was bad. We adapted to the buys from 1640s back up to the FOMC price points, and then also adapted to these buys from 1680s up as we didn't get the sell side confirms back below 1670s. What we didn't expect is such an aggressive upside move, digging into this deeper sell side liquidity zone. Everything else on gold is pretty much standard, just had more aggressive movement, understanding the market conditions. But on pairs like GBPUSD, EURUSD, and our dollar pairs, everything's still been relatively standard, right? GU has overall still just been in this corrective structure from these lows, potentially still going to retest better sell zones of interest, being previous lows in this liquidity grab area in this rough 30 to 40 pip range there. Even if we do have a bit more of dollar weakness in the range and GU squeeze to this price point, on the higher time frames, it's still extremely bearish. We have just been adapting to some of these pullback buys to retest better sell zones, right? We expected with the dollar weakness that we could go retest that FOMC price point of interest and even this previous price sensitivity area before we start looking for sells. We didn't get the exhaustion confirms at FOMC price point, instead extended a bit higher to potentially come to a double top area, but could still squeeze up to like 1.178, 1.18 flat, and still be very bearish on the higher time frames. Now, do we want to start prematurely selling? Of course not. We want to adapt to these secondary phases of market structure before jumping back into higher time frame trend. The only thing is, based on market psychology, as we've been playing dollar domination, we've had very consistent downside with very minimal pullback phases. What I mean by that is from late July, early August, we really had almost a consecutive months of very strong, easy downside, right? Compared to the previous run, as we've been playing dollar domination, where every time we print a significant low, we would enter a pretty correlated pullback phase, adapt to that pullback phase, and then jump back into the higher time frame trend, right? But ever since this pullback to 1.22, we had consecutive downside and very impulsive downside, which was the aggressive movement on the dollar domination that even led to Euro USD going below the parity point of 1-to-1 value with the dollar, and even led to GU almost hitting the parity point with the dollar and going to 1-to-1, right? That aggressive upside volatility on the dollar, high speed upside of buy orders and demand in the dollar led to other countries doing more currency interventions, intervening and trying to slow down that volatility. But in relation to this overall downside move, where we literally had minimal pullbacks besides some couple of intraday candles here, not really entering a pullback phase, having this corrective phase is completely normal and in relation to that market structure. Does that make sense to everybody? It's just that from a psychology perspective and an emotional perspective, as we are human beings and manual retail traders, we got so accustomed to that easy GU downside, Euro USD downside, gold sells during that period of end of July all the way into start of October, right? Pretty much through like the entirety of late summer there. You can see this same type of idea on Euro USD on the higher time frame, right? Overall, very bearish market structure, but we had ever since this downside move, just very aggressive impulsive price action minus this minor pullback phase here before continuing lower, right? So as we printed these lows, we're well below the parity point. Seeing this corrective phase of market structure is completely normal in relation to the higher time frame bearish trend and the upside volatility we've seen on the dollar. So from a market structure perspective, we would need to be breaking well above 1.02, even 1.03 on the higher time frame to see any shift of higher time frame structure. Otherwise, if we see with market sentiment, equities are still rallying, gold's having deeper pullback phases, dollar still bearish, yes, we're going to adapt to the potential buys in the short term, but we can't lose sight of this higher time frame image, right? Does this make sense to everybody? It's like the same thing on gold. We've been playing smooth and steady downside. We played this pullback phase. Like, look at this pattern that we had with the fundamental information advantage of the Fed rate hike cycle, US dollar domination coming from that, and less demand in these various asset classes with the whales liquidating positions. Impulsive seller move that we take advantage of, identify the exhaustion, get a pullback phase, wait for the pullback phase to complete, and then jump back into the impulsive seller move. Enter a pullback phase, wait for that pullback phase to complete as we adapt to it on the intraday timeframes, jump back into sells. Right? Identify the exhaustion. The pullback phase goes to retest previous significant lows and price sensitivity areas of interest. And we jump back into sells. Right? Pullback phase to those previous lows again. We adapt to that pullback phase and we jump back into sells. So finally starting to see the market structure and market environment shift a bit is completely normal. Seeing this triple rejection coming towards the end of the year and having a bit of a higher time frame, deeper pullback is completely normal. It's just that from a psychology perspective, we've been so accustomed to this overall move. I don't want to say trading is easy, right? It's obviously very hard to manage your emotions, risk manage, be there to take advantage of these opportunities, learn to do analysis, understand the fundamentals, and so forth. But with us understanding the Fed rate hike cycle and understanding market structure, we literally, for almost a year and a half, we're playing this consistent down, a year at least playing this downside. Right? 10 to 12 months playing that downside. So it's very easy to just get accustomed to that. I was personally expecting as well that if the unemployment rate data and everything was still good, that we'd have the continuations down. But we still had bad unemployment rate data, failed to break these previous significant lows, coming towards the end of the fiscal year, dollar pullback, uncertainty with the US elections, and more demand into the risk assets, which is something now that's finally abnormal compared to what we haven't seen before. Does that make sense to everybody? That's what can throw people off a lot. But there is the fundamental catalyst behind it. Now, as we've been playing that sell side bias, I just can't make random predictions to all of you for no reason and say, yeah, we're rejecting 1640s. We're going to go all the way to 1720. We're going to go all the way to 1780. That's not logical. That's not probable without having the confirms for it. What we can do is like, okay, we're rejecting this area, got bad unemployment rate data. Let's at least play the pullback and we can see us retest the 1680s, and then we'll watch reactions here. But if we break above the 1680s, we'll adapt to the buys, but we'll watch around 1700s. All we can do as retail traders from an objective standpoint and staying logical as day traders, scalpers, and swing traders is stay adaptive and mark out these levels of interest, right? Because if you were just to say at this time where we just rejected these lows that we're going to come all the way to 1720s, it's what information is that based on, right? How many times have we seen gold reject a low and do a bit of a pullback phase or retest a sell area multiple times and still continue the higher time frame trend, right? If we saw gold, for example, come to 1680s and reject here and fail to break higher and dollar strength come back into play, would anybody think anything out of the ordinary of dollar still rejecting 1680s and ranging at the 1660s or 1650s? No, right? It'd still be perfectly in line with market structure, right? So all we can do is not make these wild predictions and hope for something. We can adapt to these pullback phases, but we still want to stick to the higher time frames when we're looking at it level by level, right? So now, bringing that information together to the table, in my opinion, again, to summarize, for gold to break above this liquidity zone here in the low 1720, in the low 1730s, mid 1720s, we would need fundamental catalysts. Major uncertainty with US elections, new geopolitical tensions like China invading Taiwan, very bad US economic data with the consumer sentiment reporting or some of the other reports we have to close off the week. Improved inflation report, which feeds into Fed pivot prayers and leads to dollar weakness in a relief rally in equities. Otherwise, this can just be an overall higher time frame, deeper liquidity grab, where when you're zooming out, keep in mind that it's still early into the new month. And even though we may be engulfing some of these candles here, we're still just retesting previous key lows, which could be, like I said, into the 1730s and previous significant candle body lows here, where you're looking at some of these wick rejections in this general area, candle body closures, and so forth. And like I was talking about in the higher time frame webinar, we've been so accustomed to the sells, right? we seem to ignore when we zoom out that we had like 8 months of straight downside, pullback, downside, breakdown, sell, 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 right? So when you're looking at market structure, even when gold is extremely bullish here, it's not out of the ordinary that you have consecutive months of bullish upside and a bit of consolidation. Consecutive months of upside, aggressive pullback before, this was the pandemic stuff, but you get the idea. You can even see it here in a lower scale perspective where you had consecutive months of upside and then some bearish candles before continuing higher. If we still have high inflation reading, if US dollar starts to stabilize at 109 and go back above 110, if equities reject and don't break above 33,500 liquidity zone, if gold still rejects and we have optimistic US data, then we're still going to end up rejecting this move, fading it out, and maybe just getting a weaker bullish candle close here. Digging into that area, 1730, 1720s. Right? In my opinion, for us to break back above this higher time frame range, break above that liquidity zone on the intraday time frames, cancel out all of this downside price action and sellers in control during that period, we would need fundamental catalysts to support that, which would be anything that feeds into pivot prayers, improved inflation, bad US recessionary scare data, or anything that brings major fear into the markets to have gold behave as a safe haven. Or you get Fed speakers talking very dovish and shifting their stance. Does that make sense to everybody? Now, it's not always going to be exactly the same as previous, but you can see here when you had after the GFC and you had that correction, you had consistent months of downside here, right? We could say 1, 2, 3, 4, 5, even here, 1, 2, 3, 4 months of just consistent downside. You had a few months of aggressive pullback in relation to that downside, but as long as you didn't shift out of that taper tantrum sentiment, you still rejected that area, revisited the lows, and continued even lower. Right? So it's not the exact same as that post-2000 GFC period, but it's still in relation that we had the rejections from 2000, weak bullish candle close, and then just consistent downside sense. Having this pullback with the catalyst in play, and of course, towards the end of the fiscal year, is not out of the ordinary at all. And if we do get catalysts for deeper gold upside, which would be improved inflation data, Fed pivot prayer dreams, dollar weakness, then we'll adapt to that accordingly. But even some deeper pullbacks in the higher time frame in relation to this downside is still not bringing gold back to the highs and all-time highs. Does that make sense to everybody? It's almost like on a higher time frame perspective, a double top here. We had the break below the neckline roughly, and now we're coming to retest that neckline, or even if you dig a little bit higher from just given like a road mapping, if it did take place, if we do get the catalyst to break above 1730s and we adapt to deeper buys to close off the year and set up order flow for the new year, it would still be in relation to this impulsive downside move, the break of structure, and setting up that order flow of still having that sellers in control. Does that make sense to everybody? But on an intraday perspective, we're going to take it level by level. We're not just going to guess and hope that we go back to the 1800s again, right? So when we're taking it level by level now, you can see here that even when gold previously had very strong bullish price action to this sell side liquidity zone, it still gave the confirms of exhaustion, fading out that move, and sellers starting to come back into play. So we are digging into this zone that we want to look at roughly in the low to mid 1720s here, right? I can still see that if we have continued dollar weakness, we can squeeze into this area, but it's hard to see any further buys on the higher time frame unless we're breaking above 1730s. So now we want to bring this information together with what events we have on the table, because we still don't have the US CPI until Thursday. So we could still have this bit of a relief rally in equities or dollar weakness ranging around 109, gold digging a bit higher to retest these sell side liquidity zones. And then the CPI data is going to be the kicker. Now, my personal prediction is that inflation is still going to be high, and it's going to bring that cold, dark reality back to the markets that the Feds are not going to be slowing down for December. And because the rate hike path is data dependent, overall, the labor market is still macro solid and well below the poor expectations that the Fed think unemployment rate is going to go to, right? And they still have their primary focus of bringing inflation down. We just had this uncertainty, obviously, with the US elections, price setups, and of course, understanding market sentiment and order flow. Now, I could be 100% wrong. I could be 100% wrong, and the inflation report could be improved, but we would adapt to that accordingly anyways. I think that we're going to potentially retest this area, stall out, start to fade out, then for the inflation report, have a high inflation, do a liquidity grab to here, then turn bearish, right? That's my expectations, my predictions. But if inflation is improved and optimistic, feeding into Fed pivot prayers, what you're going to see is gold do a liquidity grab down first, generate more buy orders and continue up, and then start breaking above the 1730s, which, yeah, my prediction will be wrong, but who gives a shit? We'll just adapt to that. Does that make sense to everybody? My personal bias, my personal wants, I still want the stock market bears to continue. I still want the dollar domination to continue. It's been very clean to trade in the overall structure and so forth. Obviously, we understand market psychology of how it's more difficult for the stock market to go down than it is to go up, but it's extremely interesting observing these bear market rallies, adapting back to the sells, having that analysis play out. But if we get a shift in our fundamental sentiment from a macro perspective going into the end of the year, there's nothing wrong with us adapting to it and still taking advantage. So even just to give some cheat codes into inflation, let's just say that we were sitting at this current price point for inflation data and CPI report coming up. The CPI report is coming up in the next 10 minutes. We just rejected 1720s, had a bit of a drop, but then we're starting to range here. We're still sitting at this rough price point for CPI. I understand, based on the fundamental impacts of these catalysts and how the market digests the information, that if CPI is high, that we would probably either get a liquidity grab to the upside and continue bearish, or just straight start to melt and continue bearish, where we would take advantage of confirming the liquidity grab and any high risk, high reward sells, or the impulsive move, take advantage of this entire move being corrected, right? And adapt to the lower time frame and following daily candle continuations. Also creates market stability and ranges to play back to the same lows and higher time frame lows. Exactly. Right? So this is very easy. We come into the CPI day, we're rejecting this major sell side liquidity zone, or we even start to reject here and drop a bit lower than the sell side liquidity zone. The inflation report comes out. We see an upside move first, retest a key level or market structure point, we notice any rejection, high risk, high reward liquidity grab sell area. Then after the liquidity grab, we start to break back below key levels on the lower time frame. We jump in those cells. Or if the inflation reading is just high, instant drop on gold and upside on dollar, where we adapt to any lower time frame pullback and continuation back down. Right? But if inflation is improved, if inflation is improved and showing signs of improvement by dropping, feeding into Fed pivot prayers, you're not going to get a liquidity grab to the upside first. You're going to get more buy orders collected, which would be a rough retest of these previous highs, or even a 50% correction of this move, stabilize on the 1 minute, and then push bullish, and also feed into pivot prayers to break above here for a very easy, safe, higher time frame. Very easy, safe, lower time frame buys based on breaking a higher time frame price point of interest from a fundamental catalyst. The beautiful thing about understanding the fundamentals is we can adapt to either or side. Obviously, it's great to have our main analysis, main bias, main expectations to increase our confidence, to increase our experience, to increase our prediction abilities and overall market knowledge, but we're not always going to be right. So creating these scenarios in that situation when you're wrong, you can still go, aha, I already expected that. Okay, if inflation's improved, we're not going to be looking for gold sells. Dollars going bearish, stock market's going bullish, gold just did a liquidity grab. I'm not trusting the liquidity grab, but if we break back above 1720s, we're going to take those buys. My prediction was wrong, but I don't have to sacrifice a loss or chase something or be confused. I still understand the impact to take advantage. Does that make sense to everybody? But I'm personally saying that if we cannot further break above the high 1720s, low 1730s, we start to see dollar stabilize, get any rejection confirms here. And then with the CPI report, it's still high and other consumer activity is still solid. We will reject here, kill pivot prayers, dollar strength come back into the table and correct a lot of this upside move, creating more market stability of not printing new lows on some of these asset classes, just revisiting previous lows that the markets are already well adjusted to. Same thing on equities on the higher time frame here. Does that make sense to everyone? Now, in terms of economic data to feed into this, we don't have much going on. It's going to be the CPI figures as the main focus on November 10th, the Thursday, right? And initial jobless claims and stuff is still going to be important as well. After that, we don't have anything else except for some consumer sentiment reporting, which November 11th is also a holiday. Okay. But now let's look at some trade ideas for the next coming sessions. Understanding we still don't have much on the docket in terms of fundamental or economic events, still just potentially playing some of these pullbacks to retest better sell zones of interest. So in terms of economic data, nothing really going on over the Euro and London session. We got some leading business index reporting for CAD at 6 a.m. Eastern, and then some wholesale inventory reporting at 10 a.m. Eastern for the US. Won't hold that much impact at all. Keep in mind, some of the Fed speakers here tomorrow at London session close hours and later in the afternoon with John Williams and Thomas Barkin. Holidays, end of the week. Now, when we're looking at gold here, we had very strong impulsive movement where we can still dig into these better sell zones of interest before seeing before seeing any of the rejection plays and the higher time frame bias come back into play. So understanding that, if we were to break above and not fully correct this downside move, and looking to the left here at some of these key retest points in this medium term zone, break above 1715 and 1721, I would still be taking some of these pullback buys to retest that sell zone of interest to the left there, right? Now, we don't have any confirms of exhaustion yet. We don't have a double top at 1715, an order block, and break below the order block, a fundamental catalyst bringing gold sellers back into play. All we have right now is still leading into the inflation data, and still with dollar a bit softer, is an impulsive gold upside move, still a little bit of a range into the 1725s, and just a minor pullback here. For me to really see sells, we would need to be correcting majority of this move well below the 50% correction point, coming below 1698s and 1700, roughly previous intraday lows to the left here. Otherwise, we can still have some of these deeper pullback plays. Uh, 1721 is going to be based on price action, make or break, as that area of rejection we're looking into is like the low to mid 1720s when we're looking to the left. So this is going to be, if we just have continued bullish lower time frame price action, a break above there, continue to buy. But if you start to get very strong rejection confirms, hourly candles rejecting lower, 1 minute double top and so forth, then it could still be a valid sell zone. We don't have an exact pinpoint price of interest for these sells, as in this general area that we're going to be digging into, we've seen rejections both on these very highs of like going into the 1730s, mid 1720s, and even into the low 1720s here as well. So we're looking into this general liquidity zone here. Does that make sense, everybody? But a break above 1715 would still be easy continuations digging into these sell zones of interest. Otherwise, to see any sells back into the higher time frame, breaks well above 1698, or if we get a failure to break these highs in double top first, and then the break and retest below the neckline at 1708, right? So if we have a bit of a downside move, fail to still break 1715, creating a double top, consolidate, and then break that medium term zone, showing more exhaustion signs, then we could see more potential sells. It'd be like in that previous instance where we were looking for the sells below 1765 roughly, where we did get some exhaustion signs. We did consolidate and slow down the upside price action, but still didn't break that potential double top neckline and previous rejection area there to validate those safer continued sells, right? So in this situation, we could get this chain of events where we still reject here, but that would just be step one. You would also need that continued break below that medium term zone and neckline that forms, or order block low, before seeing any further sells. So the pullback buys, retest better sell zones, safer just back higher time frame sells, 1698, 1700s. GBPUSD. Now on GU, we're looking in this general area where if we break above 1.16 and hold above the FOMC price point, we can revisit up to 1.178, 1.18. Otherwise, right now, we're still showing signs of exhaustion at a potential double top area with our baby, the dollar, still failing to trade below those previous highs, liquidity zone, and lows around 1095, right? Now, the catalyst to see, even in terms of market sentiment confirms, gold having deeper pullbacks above 1715, US 30 breaking above 33,500 and doing deeper liquidity grabs, Euro USD and GU having deeper liquidity grabs. It would give us those market sentiment confirms of dollar trading below 1095, right? Even when you're looking at the price action here, you can see every time dollar has come to a range low and had a bounce, it's actually been a pretty aggressive bearish move down, and then you just have a pretty aggressive bounce back. You don't get these huge double bottoms or rejection signs, right? So seeing this impulsive downside to this range low is not out of the ordinary at all. You can even see that in smaller order blocks that have been formed as we've been having upside in the example of this situation, right? Here you're retesting previous significant highs, roughly that demand zone and order block lows. Every single time here, you can have very aggressive bearish price action down to those lows, heavy rejections there as well. But if you do not break, it's hard to play any more dollar downside because you just have those buy orders collected. And if we have dollar start to stabilize and then get fundamental catalysts supporting the dollar strength, like a high inflation report, we're still just going to have a bounce from that area. Does that make sense to everybody? So it's still a similar situation when we're looking in this general area around 1095, this order block, roughly around previous lows here, 1095 to 110. If we see dollar overnight over Asian session breaking below here and giving us that deeper liquidity grab and sellers in play down to revisit 108 or 1075, which is still a potential possibility when we did our higher time frame analysis, understanding how aggressive upside dollar has had and leading into the end of the fiscal year. If we see that move and break below here, this is also going to correlate and give you very easy confirms that on GBPUSD, when you come and look at the key levels, we will break above 1.165. Epic fan frozen. We will break above 1.165 and have an extended squeeze up to potentially 1.178, 1.18 before seeing any sellers coming back into play. Right? So we would be breaking above this intraday high, which is also a key level. Understanding dollar has that weakness. We also go look at equities and they're having that relief rally. And then we can easily expect to dig into this sell side liquidity zone, but you would take advantage of that up to that better sell side liquidity zone. Right? So bringing this information together in terms of trade ideas with some of our key levels and of course market structure points, double topping or failing to revisit or break these highs and holding below 1.155 with the dollar still being stable and not breaking below that range, breaking below 1.15 or 1.45 would be jumping back into the higher time frame sells. Equities start to give back gains. Dollar holds the range lows. We fail to break above key level in previous intraday highs, right? Otherwise, if we have this first portion of the move and start to push bullish, but dollar is still bearish, we break above these intraday highs and key levels, we know that we're not going to start to prematurely sell. We don't have the price action confirms for it. We don't have the market sentiment confirms or fundamental confirms for it. We're going to take those GU buys up to that deeper, higher time frame sell side liquidity zone. But during this phase on the upside, whether you're scalping or day trading, you're going to be taking buys up to that higher time frame sell zone. Does that make sense for everybody? Even in this corrective structure, we could have something where we have an intraday high printed, we come to double top in that area, have hundreds of pips of downside, and then get another fundamental catalyst for pullback. So we could have the rejections here, dollar strength come back into play, have these sells, and still be in corrective structure. Right? So that's why I don't want to see any more further buys unless this situation here, where you have the break above those rejection points, even the break and retest with the dollar sentiment confirms, then you squeeze to better sell zones, where even then you did this double top and had the sells from key level down, FOMC down, Bank of England down, right? So I can't see any more GU pullback buys unless we break above 1.165 with dollar weakness, relief rally in equities. Euro USD, similar idea here. Now, the neckline of a potential double top is being formed between these ranges. This gives us good confirms that if dollar domination just comes back into the scene, dollar fails to break those range lows, equities give back gains, we have bearish lower time frame price action, that we can easily just jump back into the higher time frame sells below these price sensitivity areas. Otherwise, only continued pullback buys to retest better sell zones of interest, similar to GU, with dollar weakness, break above this intraday high, and then leading to better sell zones of interest on the higher time frame there. Right? UCAD, more of the inverse, but we're having a deeper pullback phase to this previous liquidity zone and key level around 1.34. And similar to dollar failing to break below the range, we've also failed to break below here. UCAD, if we double bottom in this area, would be high risk, high reward buys. Break above 355, break above 365 would still be UCAD buys. Even a pullback and break above the DB leg. I can only see any deeper sells if we break well below this key level, invalidate the buy analysis, have continued dollar weakness breaking below 109.5, 109 area, and breaks below 1.338. US equities extended a large bear market rally, but nothing we haven't seen before in terms of the size and also how long it's been extending, right? So this was a rally of almost 4,500 points and over a period of 68 days here. Here we've had a rally of around 4,700 points in a period of almost 41. Actually, we can go right here, and almost 50 days here. Right? Now we're still digging into this key sell side liquidity zone and previous fundamental price point of interest here. Now, if we cannot break above this area, the next key sell zone or price point of interest is 34,234K. So this is a very similar sequence of events. If we see dollar stabilize, a double top and fail to break above 33,400, turning bearish below 33K or below 32.5, we will see the higher time frame sellers come into play, buyers exiting positions and revisiting these better price points of interest, creating that market stability. Remember, we already expected with how last week finished in the data and the delusion of stock market buyers and market timing that we could revisit FOMC price point and even a little bit higher, right? So the buys would be if we push up, break above here and validate the sells, breaks above 33,500, which I take up to 34.2 before seeing any sells. Does that make sense to everybody? And I want to show you guys a couple of examples if this makes sense. Okay, now look, I want to show you guys these examples. Look at some of these periods where we did have a bit of a double top occur. These are two good examples here, right? See here, you have a low printed, bear market rally, false bottom, delusion, hard rejection here, a bit of a downside move. That move gets corrected. You actually break a little bit higher, revisiting a bit of a deeper sell zone of interest in previous lows, still end up fading out that move, breaking and retesting below the neckline and continuing back down to those lows in lower lows, right? So this type of formation here, almost giving one more leg to the buyers and one more trap there, is pretty common when you with US 30. Let's look at here as well, right? So similar sequence of events, low printed, overall higher time frame bear market. We know fundamentally why. During that period of time, we enter a pullback phase, You don't get any real signs of rejection, like here just having consistent pullback until this first area of rejection, and then you have a downside move. This doesn't just lead to instant downside and full correction of the upside rally. You have price stall out a little bit, even dig a bit higher than the double top area, still end up snapping below, almost being a trap, break and retest below the neckline, and then still continue bearish there. Does that make sense to everybody or no? Right? So when we come and look at US 30 here, we're seeing something similar. Low printed, pullback phase, delusional relief rally. First hard sign of rejection here, stabilize a little bit, break a bit higher than that price point of interest, revisiting this better sell side liquidity zone. But if we start to snap back below those previous highs, we can expect that, especially if we get dollar domination back into the scene, coming back to here, breaking, retesting, and then this type of price formation. For me to see any more US 30 buys and be a different sequence of events to what we've highlighted in those previous scenarios, we would need to be continuously breaking above this high here, going to the next zone of 34,200, 34,500, right? Let me show an example. Drag this over and let's bring it here. We would have needed to break above here to see that continuation move, right? To see any more buys. We would have needed to break above here to see any more continuation buys. So having these extra squeezes on US 30, even going a bit above a double top, showing like you're going to have more of an aggressive continuation, is very common when you're looking at the behavior of the equity markets. Does that make sense to everybody? So I can't see any more upside unless we break above here, which that would be very smooth and steady buys with dollar weakness, gold having some upside and other risk assets holding bulls, and us having a very clean range up to 34,200s. Otherwise, if we don't break above here, come back below these previous highs It's the exact same sequence of events that we've seen in this overall bear market before. Understandable? Right? So it'd be like if we were looking at this sequence of events, we were looking for sells here, but we broke a bit higher. Right? We broke a bit higher. And then we could not see any further buys unless we were trading above here. You can see you get that little bit of an extra squeeze. This is almost 8 to 12 hours of continued bullish price action breaking a bit higher. But then you snap back below there, come back to the range lows. You break that double top neckline. You retest there for more sell side liquidity before continuing lower. Here, you break a bit higher here, right? You're staying above that price point for, again, another 4 to 8 hours. But as soon as you break back below, you revisit that neckline, pull back to there, and continue bearish. So now when we're looking at the current sequence of events, we've had this double top. We've broken a bit above there. But if we come back below, it's hard for me to see any more further buys on the stock market. We would need those fundamental catalysts. Very bad US economic data, improved inflation, dollar breaking well below 1095, and so forth. Does that make sense to everybody? So now that's why these trade ideas are mapped as is. High risk, high reward sells is still rejecting that exact previous sell zone, coming back below the lows and back below key levels. Only continued further buys above 33,500, a bit above 34K to 34,200 before seeing any more rejection signs. Understandable? More than likely, if you're breaking above 33.5 here, you're also going to get market sentiment confirms of global equities pushing more bullish, dollar breaking below 109, and so forth. So you can use those market sentiment confirms to your advantage. But we are at very key price points across the board. Gold entering very key higher time frame liquidity zones. US equities entering very key higher time frame liquidity zones where we've had fundamental catalysts lead to sell-offs from here before. Dollar at a very, very key liquidity zone of roughly the previous highs and these lows around 1095. And same with the currency pairs. So we do want to stay very adaptive. That's why we have these scenarios laid out. That's why we want to look at market sentiment and use all the concepts taught in Capital Hungry. Now, GJ starting to enter an area here where previously when we enter this area, we see some ranging, right? We have very clean moves when we break below to revisit this demand zone, very clean moves back up into the range, very clean moves if we break above. But in this overall range can get a bit messy and indecisive. What we had as per the market update was a retest of our key level and some continued bounce buys. But we didn't have enough buyer order flow to revisit those highs or break higher. The same time in the short term here, the same time dollars consolidating and having a pullback from the highs, yen is having a bit of a deeper pullback from the lows, which is perfectly expected. So we're seeing that bit of strength in the yen, nothing crazy, nothing surging in terms of huge economic fear, but yen is still holding some strength. The same time, a lot of the GBP upside has been digested and priced in. Keep in mind, on a higher time frame perspective, GJ is at very key higher time frame highs above these price points of interest here, right? So now I still want to play the bullish side on GJ, but it wouldn't be out of the ordinary to get some deeper liquidity grabs, double bottoms, and so forth. Deeper liquidity grab to 167.2, hold of the key level, breaks above and canceling out this downside move, breaks above 168.5 would still be GJ buys. Okay, I can only see sells to revisit these demand zone lows again if we cancel out some of this upside price action and break below 167 flat. Only adapt to sells if we see yen pairs overnight gaining strength as a whole, breaking below that double bottom area roughly here and canceling out some of this more upside price action, then adapt to the sells. 167 sells only. Also keep in mind, if we do have the buys, that to see a continuation of market structure, whether we get the liquidity grabs or not, we would want to see new intraday highs printed. We don't want to just reject at the same high and then just enter that range I was showing you guys to the left here, right? Does that make sense to everybody? So GJ higher time frame still bullish, intraday still bullish. Great calls from previous weeks of buys from this demand zone. Nice buys that have gone up from the start of the week. Solid pullback from last market update webinar to 167.5. I was expecting that we'd get a pullback to either these previous highs roughly and just have very smooth and steady, easy price action. But the deeper pullback was the 167.5 call, which we still had 100 pip bounce from there and now entering that bit of a range. This overall area here, you can see, besides when we have fundamental catalysts, right? Besides when we have fundamental catalysts, we get very aggressive bounces here. This is only from currency interventions, Bank of England sentiment, and so forth. In regular conditions, even though we may not break the highs right away, we do get strong support of buyers or of buy orders being collected in this area. Why 167.2 for the sells? Why not 167? Oh, sorry. Why 167.2 and not 167 for what? The sells? If we start to break below 167 here, we're canceling out a lot of this upside price action. We're breaking below that double bottom area, which would show me in terms of order flow, this sequence of events. One, this high printed. A pullback phase that was like to what? 167.3 here, just a bit below the PPL. That pullback to generate more buy orders, not enough buy liquidity to revisit these highs. If we break below there, I'm expecting deeper pullbacks than just like a 20 pip one. Does that make sense to everybody? Now, getting a double bottom in this area and collecting more buy orders and still rejecting makes sense. But if we start to break below that potential double bottom area, it shows me higher probability of deeper pullback plays before continuing more bullish. So I would want to hold where this double bottom area was, where it's just like 10 pips shy of 0.2. Does that make sense? And I would not want to cancel out all of this bullish price action here as well. We would just be ending up mirroring some of these moves to the left. Does that make sense? Even when you're getting rid of the PPLs. It's not saying that 167 buys are wrong, but I just see that if we cannot break these high points, if we cancel out this upside price action, if we're trading below the lows here, that we have a higher probability of mirroring this move and canceling out this upside candle, breaking back below these areas, having deeper pullback phases. Does that make sense? I'm not saying you could easily see lower time frame rejections at 167 and see potential buys there. But in my understanding of order flow and understanding how these sequence of events go, if you eventually cannot break significant high points multiple times, if you break that leg area, which would be this case in the situation, whether it's a fundamental catalyst or not, whether it's impulsive or not, you do get deeper pullback plays to better buy zones of interest, which I would see if we have a similar sequence of events here, right? Does that make sense? Right. But anyways, everybody, bit of a long webinar. Didn't mean to Exactly, Tarsi. We don't know the exact point because we're not the market makers. We don't know. If we knew the exact point, none of us would be sitting here. None of us would need to do any of this, right? If we got some text to our phone from Jerome Powell said, you know what, Jeev, US 30, this is the price point where the short orders are. This is where we're loading them up. We would be rich. We wouldn't even need to study the markets. You just need to enter, right? But we do not have that luxury. We have all this mystery around the markets where we have to do logical and objective analysis based on fundamentals, market structure, key price points of interest, and then come to the table and bring those concepts of, okay, we're coming here and rejecting. We're coming here down to 167.2 area. I'm noticing a 1 minute double bottom. I'm going to take some buys. Or I wasn't confident in the 1 minute double bottom, but we had that rejection and we're correcting this downside move. I'm going to jump in the buys here for the continuation move. Or we're breaking above these highs now. I'm expecting a new intraday high to be printed, going back up to these higher time frame highs. Yen is still weak. We're still seeing solid bullish price action. The lower time frame confirms respect to higher time frame structure, and you bring that information together. If we had 100% certainty in every trade we entered, we would all be billionaires, trillionaires, right? We would all do 100% bet every single trade. You just made 100,000, you would bet 100,000 again because you have 100% certainty. Why not? You know what I mean? But the market doesn't work that way. But anyways, everybody, I'm going to save and upload this, and I'll see all of you later.